Exchange-traded funds called dividend ETFs hold equities with a proven track record of paying dividends to shareholders. Fund managers make sure the holdings are always ones that pay out respectable dividends when you own a dividend ETF. The management of a dividend exchange-traded fund, like those of any other exchange-traded fund, selects a portfolio of stocks to reflect the makeup of a dividend index. The resulting portfolio offers its owners a cheap investment asset that can generate income. Welcome to my YouTube channel. Don't forget to like and subscribe to this channel for more intriguing videos like this. And be sure to watch this video to the end. Without further ado, let's dive into it. Investing in dividend ETFs may be more convenient than owning and managing your portfolio of individual dividend stocks. Dividend payments are never assured, unlike bond coupon payments. Thus, it takes more work for individual investors to maintain a portfolio of dividend equities. You should consider the following factors while picking a dividend ETF. Yielding dividends. This represents the portion of the purchase price that was used to pay dividends over the previous 12 months. A $100 ETF has a 10% dividend yield if it pays out $10 in dividends each year. Dividend expansion. A company's current dividend payment does not guarantee that it will continue in the future. There is no assurance that dividends will increase over time, even if it preserves its dividend. This is why some investors favor investing in companies dubbed dividend aristocrats. The S&P 500 companies have a lengthy history of increasing their dividend payments over time. High dividend yield. This relates to the stock selection and credit standing of the ETF's holdings. A fund's value is more likely to decrease and take your total return with it if it invests in riskier companies with lower credit ratings. As a general principle, to increase yields, avoid funds that invest in risky companies. The highest yielding dividend ETFs might have yields that fluctuate more over time and have less assurance that they will stay that way. The highest yielding equities frequently experience significant losses during market downturns. Because of this, it's crucial to take quality, dividend growth, and current yield into account. Traditional dividend ETFs own businesses that won't expand as quickly as the market as a whole. Investors should therefore be aware of any trade-offs they made between obtaining yield and capital appreciation through growing stock prices. If your only concern is making as much money as you can choose companies that are well positioned to increase in value and then sell off shares when you need to for income. Now to the top 6 monthly dividend ETFs. Number 6. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. Another one of my top dividend ETFs is SPHD. However, it has a reputation for being erratic in its performance. From 2013 through 2020, with one exception, the fund consistently outperformed either the top 5% or bottom 10% of its peer group. This is one of those ETFs that requires careful timing. But if you do, your portfolio will benefit from having a top performer. The S&P 575 highest yielding equities are first identified by the fund, which then selects the 50 stocks with the lowest volatility from that list. Income investors will likely enjoy the 4% dividend it offers, but this fund is just marginally less risky than the S&P 500. Additionally, it has a 50% allocation to healthcare, consumer staples, and utilities, which suggests that it will be well positioned in the event of a market downturn. Number 5. Wisdom Tree U.S. High Dividend Fund, DHS. The Wisdom Tree U.S. High Dividend Fund, DHS, is a replication of the Wisdom Tree High Dividend Index, a fundamentally weighted index that includes corporations with average daily trading volumes of at least $200 million. The index is comprised of companies ranked by dividend yield. The holdings of the fund are well diversified across industries like consumer staples, utilities, healthcare, real estate, and healthcare. Number 4. Invesco Preferred ETF, PGX. The ICE BOF AML Core Plus Fixed Rate Preferred Securities Index is followed by the Invesco Preferred ETF. By rebalancing the fund and the index monthly, PGX achieves its investment goal without purchasing every security in the index, instead employing a sampling process. Nearly 300 assets make up the fund's holdings, the majority of which are banking institutions like Citigroup and Wells Fargo. PGX started trading in January 2008 and currently has $5.3 billion in assets. The 30-day SEC yield for it is 5.78%, while the 12-month distribution rate is 5.61%. Each year, investors pay 0.51% to buy the fund. In the middle of September 2022, the fund traded at $12.40. It reached its peak when it first began trading, $22.65. In February 2009, the price fell to a low of $6.14. From there, it formed a V-bottom and rose 145% by 2013. Since then, the price of PGX has fluctuated, with the present price being at the low end of the spectrum. The majority of investments are made in BBB-rated securities. Number 3. Global X Super Dividend US ETF, DIV. The Global X Super Dividend US ETF, which began trading in March 2013, has $723 million in net assets. The fund seeks to invest in 50 of the highest dividend-paying U.S. stocks with low volatility and high yields. The majority of the fund's holdings are businesses in the banking, utility, consumer goods, and energy sectors. Sabine Royalty Trust, Iron Mountain, and Consolidated Edison make up its 3 largest interests. A 30-day SEC yield of 6.81% and a 12-month trailing yield of 6.12% are available to DIV investors. It provides a 0.45% annual expense ratio. The fund's ATH was $29.94 in November 2014, and it is currently trading at a little over $20 in mid-September 2022. In March 2020, the cost fell to an all-time low of $10.58, and since then, its worth has doubled. The price chart for DIV suggests a potential V-bottom formation, which typically denotes an uptrend. Number 2. Invesco KBW High Dividend Yield Financial ETF, KBWD. At least 90% of the assets of the Invesco KBW High Dividend Yield Financial ETF are allocated to securities of publicly traded financial businesses with attractive dividend yields. It is updated quarterly and tracks the KBW Nasdaq Financial Sector Dividend Yield Index. Chimera Investment, Orchid Island Capital, and Arma Residential REIT are just a few of the businesses the fund has investments in. The 30-day SEC yield for KBW, which began trading in December 2010 and invests in about 40 securities, is 10.04%. Investors pay a high expense ratio of 2.59%, while the fund's 12-month distribution rate is 9.50%. Net assets for the fund total $427 million. The price of KBWD in mid-September 2022 is $17.38. The fund's price achieved its highest point in May 2013 at $26.66, before falling to $9 in April 2020. The price ranged till the start of that year. In 2 months, the price rose to $21, although it has since somewhat declined. Investors who hold monthly dividend ETFs benefit from some advantages over those who hold quarterly dividend ETFs. Number 1. Global X Super Dividend ETF, SDIV. Because the Global X Super Dividend ETF invests in 100 of the world's highest dividend-paying stocks, the fund has been dispersing monthly dividends for 11 years. Investors have been able to attain geographical portfolio diversification and excellent yields thanks to its worldwide investment strategy. The financial and real estate industries of Brazil and the United States make up the majority of the fund. Common equities and real estate investment trusts, REITs, in organizations including Yuxu Property Co. Ltd., CPFL Energia SA, and Omega Healthcare are some of its largest assets. Having started in June 2011, SDIV has amassed net assets worth $765 million. Midway through September 2022, its net asset value, NAV, was a little under $9. The price of SDIV peaked in August 2014, hitting an ATH of $26 and 19 cents before starting to decline. The price reached a low of $8.08 during the global lockdown in March 2020, and it appears to be reaching that level once more. Total yearly expenses for owning the fund are 0.58% for the fund. The 30-day SEC yield for SDIV is 11.57%, while the 12-month trailing yield is 13.64%. The index review takes place every quarter and is based on dividend reductions or a company's outlook for its dividend policy. A monthly passive income from owning monthly dividend ETFs makes it possible for investors to set aside money for expenses. Since monthly dividend amounts are more predictable than quarterly dividend amounts, investors may more accurately plan their cash flows, reinvesting more frequently. Investors who wish to maximize their returns want to reinvest dividends frequently so that their interest compounds more quickly. Highly diversified. Fund managers look for the best stocks to offer investors high dividends. Investments in international shares are typically necessary for that, lowering the danger of home market crashes. Investors have a wide selection of sectors to choose from even when investing in a domestic monthly dividend ETF. Thank you for watching. Don't forget to like, hit the subscribe button, and turn on the notification bell to watch more videos like this. While you're here, click one of the 2 other videos on your screen to watch. See you later.